Thank you very much to everybody for joining us this morning. Probably congratulations for almost reaching the end of the session. We're nearly there, and we promise to make this an exciting and an illuminating discussion to help get you through to lunch and the final parts of PRI in person. As an introduction, my name is Simon Whistler. I'm the Senior Manager for Real Assets at the PRI, and I head our work on infrastructure. And we have a very active community of infrastructure investors, several of whom have been here at the conference. We've got a couple on the panel as well, working through our advisory committee, and we'll talk probably throughout the panel a little bit about touch on some of the work that we have been doing and will be doing going forward. Just a quick introduction to the panelists, and you'll obviously hear much more from them over the course of the session. To my right, immediate right, is Kristian Fok, Chief Investment Officer at Cbus in Australia. Delilah Rothenberg, the Operating Advisor for ESG and Impact at Pegasus Capital Advisors. And Martin Ewald from Allianz Global Investors. We do have a polling question to kick things off. We'll come back to the result later on, but we just want to have this as a kind of a theme as we go through the conversations today. And the question, if you go into your app and you click on the infrastructure session, this session in the app, on the bottom left-hand side, you'll see the polling question, and you can submit your answer through that. A very simple question: do you make use of the SDGs in steering your portfolio, either as an LP or as a GP? And as I say, we'll come back to the answers. Come back to the answers later. So plenty of time to submit your answer. I wanted to kick things off by asking, in some ways, what are we even doing about here, talking about impact through infrastructure investments? So if you think about infrastructure, it should really be a no-brainer. Whenever you see kind of headlines about a new road being built, a new port being built, or a piece of social infrastructure, it's going to be, I don't know, it's going to generate X amount of economic benefit for the wider region. It's going to generate so many jobs, or whatever it may be. And so impact is something that is kind of essential in many ways to what is infrastructure investing. And so I think to start with, and maybe with Martin, and come to you first in terms of why are we talking about impact in its broader sense in the terms of infrastructure investment? Is it as simple as it does generate economic benefit, it does generate jobs, it does help with community development and the like, or is it something more to it than that we need to discuss?
Maybe breaking also down, like, why are we talking about infrastructure so much right now in general first, and then also why talking about impact. And I think the rise of infrastructure as an asset class in general over the last years enabled this sort of discussion. And I think also, and Kristian and I had a pre-discussion earlier, like it's a bit of change in paradigm on how you invest and what you really want to achieve and what you can achieve. I think this is really something where we're now seeing technologies evolving and gathering of data really allowing to invest with a purpose rather than just financial purpose only. And if we then bring that together, the rise of infrastructure, the more professional environment we're facing in all sorts of the value chain, together with the ability to really understand what you're doing. So if it's just renewables where you save carbon and allow yourself to really measure how much carbon you save on the long run, or then buildings where you can also start measuring the impact you have on communities. I think it's just the abilities we currently see to understand things better, and this is why also we have such a big of a discussion, and also see that now being more of a center of attention when it comes to investments. Mm-hmm, mm-hmm.
And where do you think the demand is really coming from in terms of impact through infrastructure? Is it something that, from an LP perspective, is more and more demanding of GPs? Is it a government thing? Is it a beneficiary thing? Is it a community thing? Kind of where is this coming from? Where's it going to be going?
I think the aspirational level clearly is also set by the political agenda. Like if you look into France and all the requirements also for reporting, really then pushing GPs to be more transparent also on what they're doing. But ultimately it's also the asset owners. And if we listen to Kristian and his portfolio, how they really dig into their portfolio and how they understand things better, allowing them also to set different aspirational levels, this is really then ultimately creating the push also for developers and providers of assets, then, and the way and how they have to think about assets, how they have to build, operate, ultimately pushed by the owners.
Mm-hmm. And just thinking, like, Kristian, at the very sort of broadest level, what are some of the kind of, maybe some of the challenges that may get in the way in this? And I'm thinking specifically around essentially the enabling environment and the work with government and in terms of promoting and developing projects or creating the right environment for impact to be generated.
I think it's interesting because when asset owners look at infrastructure, you sort of focus on the what, the building, the bridge, the airport, or the port. But really, I think when you actually have these things, and when you're either owning them, these are businesses, right? It's really the how you go about doing it that's really important. And I think it's one of the reasons why the concept of privatisation is actually quite challenging for many governments, and even those governments and others that live in countries where it's a little bit more established. It can be quite challenging. But the reality is, as we know, there is a need for infrastructure to meet growing populations to the extent, and it's at such an extent where governments can't really do it themselves. Mm-hmm. And certainly in Australia, one of the sort of the interesting things is that traditionally infrastructure has been mainly owned by the government and ultimately the people. And what we have been seeing is that as pension funds get involved, effectively it's being still owned by the people, but just through a different mechanism.
Yeah.
I think it's fair to say though, and we just need to be really careful about this, there are some things we can successfully run privately. There are some things that are sort of a bit more marginal and needs government support, and there's some things where probably actually it's much better for the government to run. But bearing in mind that effectively when you own these things privately, you're sort of taking something that has traditionally been run by the government for community purpose. You sort of got to remember that you don't forget that when you're running it as a private owner.
Yeah, and are there, so what are kind of almost the incentives that need to be whether put into contracts or kind of regulations to encourage that in that type of investment, that type of operation?
So I think, clearly when a government takes, say it's a government type of sale, the government can actually construct the way that the revenues are earned, and often there's sort of specific criteria around what gets paid. Sometimes it is sort of a they cap the fees or something like that, mm-hmm. And then you sort of take variability in volumes. But often in there though, the government will require certain performance requirements, and if you don't meet them, you're penalised. Particularly in assets like water, for instance, the regulator comes through and actually sort of determines, okay, what are your KPIs in terms of leakage and service standards. So you can sort of, that's one end, mm-hmm. But then as an owner, you can make a choice to either just try and meet those minimum standards, or you can really think about this asset in a sort of much longer term way and try to actually optimise around that. So you can either earn more money because you run the asset better and therefore people want to use it more, or you can do things well which potentially offers the opportunity for you to engage with government around either an extension in how the length of time you operate it, or to to negotiate, and we see this quite a lot. There might be a greenfield sort of opportunity that's adjunct, but you need to negotiate a variation in your concession. And the thing is, in this market, it's very difficult. It's highly competed for assets, and pricing is sort of going up, and there's really incredible value if you already own an asset to be able to initiate an extension of it with the government in a sort of a one-to-one sort of basis. So for me, the way you operate an asset and go above and beyond has significant potential to create upside in value as well.
Yeah. And is that, would you say that's kind of the main driver for why you do it?
Well, I think, certainly when you're a private owner of these assets and you own it for a long time, your reputation as an owner is attached. And to be honest, you think you're doing the right thing. Sometimes you go, okay, look, I've got an investment in, say, renewable energy development. But unless, for instance, the way you appoint your contractors, the way you think about health and safety, the way you think about supply chain, if you don't think about that carefully, then your good intentions could come completely undone. And what you think is positive impact has unintended negative impacts.
Yeah.
So it's really important to, as an asset owner, or even if you're investing in a fund, to not only just sort of think about the high level, does this look good and make me feel good? You really need to think about, well, how are these companies being run on your behalf, and what is the outcome of that in terms of the reputation on you as an owner, but also in the community.
Yeah. And Delilah, your focus with Pegasus is often very much in emerging markets. How much of what Kristian is talking about here, does it resonate with your experience? Kristian and Cbus looks very much at Australia and developed markets. And so do you think there's a fundamental difference between emerging markets and developed markets from this perspective, or is it just that in many cases the potential for impact or having greater impact is probably more in emerging markets, but you have to approach it essentially in the same manner, and these issues in the same manner?
Yeah, thanks for that. Well, just to take a step back, Pegasus is mostly focused on developed markets, mostly North America, but we do some investing in developing markets, and we particularly do that. Some of it's out of our funds and some of it's with partner capital. And my background prior to joining Pegasus is very much, not entirely, but very significantly in developing countries. So the frameworks that I've been using for a long time are the IFC performance standards and EHS guidelines, and they're very prescriptive in terms of mitigating ESG risk in development of, in particular, projects and infrastructure. So it's been very useful. In terms of the specific question, I don't think there's a difference between the risks in developing countries and developed countries, and I think that's a big mistake that's been that's manifested in the markets. In terms of the Equator Principles, I'm not sure if everybody in the room is familiar with them, but they're a set of principles that a lot of financial institutions, particularly banks, use to manage their E&S risk, not necessarily the G, in projects. And the Equator Principles say that in essentially developed countries you should follow legal and regulatory requirements, and in developing countries you should use the IFC performance standards and EHS guidelines. That's an oversimplistic way of explaining the Equator Principles, but that's essentially what it is. And I actually think that the IFC performance standards and EHS guidelines have really good guidance that should be applied in all markets. For instance, the way indigenous peoples are referenced in IFC performance standards is very specific. And if you're just following legal and regulatory requirements in a developed market, you might not be engaging indigenous peoples in that stringent way. And then also just community engagement in general, this idea of free, prior, and informed consultation. You're developing an infrastructure project, great. It might be wind, it might be solar, it's making a positive impact in terms of climate, but for that particular community where you're developing the asset, do they want the asset there? Are you displacing them? Are you, displacing their access to a water source or some ecosystem services? Are you disrupting the environment there? And I think that the performance standards and EHS guidelines do a really robust job of instructing project developers of what to do and how to do it, putting in place an ESG management, well, it's an ENS management system, but we use an ESG management system. They're a little weak on the governance aspects, and you have to complement the performance standards with that. But it's a framework that I think should be used in both markets.
Yeah, thank you. And I want to explore a little bit more this idea of particularly risk in the context of emerging markets and potentially the relationship with impact, in the sense that a lot of people perceive, or there is greater risk in many emerging markets as opposed to developed markets. By, let's say, explicitly looking for projects or developing projects with impact in mind, do you think that does that help to potentially de-risk the project, or is it sometimes kind of vice versa? If you reduce the risk up front, then you're able to create greater impact, or are we kind of looking almost too far here for a relationship?
I mean, I don't think that you can have a net positive impact without mitigating risks. And the way we think of project development is you have to engage stakeholders throughout the entire process. And you have to do your very best to ensure that the communities who are impacted, the workers who are involved, are treated fairly and have buy-in. Otherwise, you have a potential risk, right? You might have opposition to your project. You might lose your social license to operate. The regulators might say, oh, this isn't going the way we expected it to. We're gonna, put a stop order on the project. So that's one example of de-risking through simultaneously making a positive impact. I would say also that when you go, most projects are financed with a significant amount of bank debt, right? So when you go to the lenders, frequently they'll say, I want to read your environmental impact assessment or environmental and social impact assessment, EIA or ESIA. And they'll look to see if you actually engage the communities, assess the environment, identify the biodiversity that you might be removing from that particular site. And if you didn't do everything according to international best practices and you only did it according to legal and regulatory requirements, and this is particularly in developing countries, there's a chance that the bank might say, oh, you have to go back and you have to do more studies and we need more information, and that could delay the project. And that can make you have to spend more money and backtrack. So that's another form of de-risking, and health and safety issues, or if you're working on a dangerous project and there's an accident, you need to make sure that you have the right systems in place to prevent those things from happening.
Yeah. So let's, I guess, take it a little bit from almost a theoretical into the practical and what it looks like on the ground. So Martin, maybe provide me an example or two of some of the projects that you've been investing in, working on, and kind of how some of these frameworks, how some of these ideas have actually been applied in those.
Yeah. I'm very happy to share just maybe some remarks to Delilah's point. Totally agree, of course. But I think the interesting point also here is, and you asked earlier about like where the push comes from also for impact. We really see that, of course, the institutional capital, and then the way also how LPs challenge then the GPs or asset owners, that's then the way. And just to also do a bit of a side remark to our working group, the Infrastructure Advisory Committee, where we also just published a due diligence questionnaire on how LPs can challenge their GP on how they integrate ESG. I think that's the same also what we should see then on the impact side, so that really the GP is challenged, like how do you intend to generate impact, how do you measure How do you bring it forward? So this whole long-term approach, which is something, of course, as infrastructure is a long-term investment, also a long-term opportunity, but it's also a long-term thing you have to be doing. And I think you really nicely can see that in developing markets where, as you said, like you have to engage in order to secure that. And therefore, it's way more transparent. And with regards to examples, in our case, it's rather easy. We run renewables funds, so we own and operate a rather large fleet of wind and solar assets across Europe. And there, essentially, what we do is we follow the clean development mechanism sort of approach in order to come up with net carbon footprinting. So therefore, we report on the net carbon footprint. And I think long run, and Kristian can share plenty of examples also from other sorts of infrastructure investments. Long run, what I would hope for is that this sort of also reporting requirements really will fade into all sorts of investments, because this is then ultimately a way on how you can think also differently about your asset. As soon as you start measuring, as soon as you start realizing what your real net impact is, this helps you in searching for different sort of assets. And for us as a provider for institutional fund solutions, also that helps us in framing how we build our funds and how we then what we address. And impact is for us really one of the really large topics we want to follow after.
Okay. Kristian, the floor is yours in terms of...
All right. So I've gone through, just had a look at some of our portfolio and through a couple of our managers. So I'll give you a couple of examples. So it's interesting when you think about infrastructure, you think about, let's build some wind farms and so forth. But yesterday we announced on our property portfolio that we would be putting in targets, science-based targets to reduce or to basically target net zero carbon. But when you think about an infrastructure portfolio, you've got all these businesses that are also consuming energy, and we're likely to take that sort of approach on property side and start to look at our infrastructure in the same way. But an example in our portfolio is the Manchester airports. It now currently has 100% of its energy in terms of electricity generated by renewables. It has undergone a transformation project which creates jobs for 150 apprentices. And it's looking at other ways of reducing impact, so using biomass, heating and so forth. So that's just one example. Mm-hmm. So even though you think about an airport as providing one service, actually the way you operate it can make a difference. Water assets. What's good for a water asset is actually to reduce leaks and to encourage more efficient use. But it's also good financially as well. If you think about water as a scarce asset, how you manage that is really important. And the way, so we've got Anglian Water, which has issued green bonds and sustainable water and recycling for its projects. It takes, I toured it a couple of years ago actually. It takes some of the, as it goes through the waste process, it actually takes the gases from that and uses that to generate electricity, which is used for its operation. So again, thinking about your business and knowing it well, and then really looking at how can you do things in a more sustainable way, but also it reduces costs. Indiana Toll Road. One of the issues that was in that road was there was a lot of accidents and lost time injury frequency was 2.2% in 2014. But through much better management in terms of how thinking about safety, visibility, communications, that's been dropped to 0.4%. Also putting in, really thoughtful sort of incident management responses. So if you think about it, you make money by having more cars through. People hate paying tolls if they're going very slow. So being able to have a much more faster response to dealing with accidents, and also to be able to preempt, for traffic that's coming up, slow them down. All those sort of things are really important. But again, the other thing is you're burning less fossil fuels because you're allowing traffic to move at a more optimal speed. So, I mean, there are a couple of things. Brisbane Airport. Brisbane is a nice sunny place, gets lots of sun, and PV solar panels are actually very economically viable. And so you've got an airport that operates with, uses a large amount of electricity, and in Australia power prices are quite high because we don't have very good energy policy to manage the transition. But if you're a business and you know that you have a demand or cost, it actually makes economic sense to put solar panels on your premises and use that to help power your business. And in fact, what is difficult for an investor, which is volatility in energy prices, if you're actually trying to build a renewable energy, wind or so forth. From a business point of view, it's actually the opposite, right? You're quite willing to spend a chunk of money because you're removing volatility risk in prices because you've got one capital outlay, and typically the payback periods are sort of like 4 years or 5 years. So doing the right thing and making money in that instance also comes together.
Yeah.
And if I might add to that, the interesting part is also if you see the variety of the examples you gave, and then also the KPIs you would need to utilize in order to explain what kind of impact there is. And I think this is what we currently see, like this whole impact measurement, and across Allianz we're also working on finding a unified approach towards like the KPIs you then can use and then ultimately maybe unify to some sort of like impact alpha or however we want to call that. I think this will be key. So as soon as we're really able to find one common denominator, one impact currency, and I think that will be interesting. And therefore also when we ask this question about the SDGs, I think it's a good starting point to have the SDGs, but then ultimately it's really about pinning down. And then the other day there was also a panel on technology and how we can use that, and maybe also really a blockchain might be something where you can code in all this information about the impact you generate on this specific project, ultimately really creating that sort of transparency, because this is really that sort of info currently is lacking. And ultimately I think when we talk about impact, also the carbon markets, which is, I really find it still a shame like what happened to the carbon markets, because they were a good starting point to find this one global currency which you could use in order to measure as a starting point. Something like blockchain was not baked in, but at least there was something, and this was let go. And now this whole impact movement, like all the approaches we see, be it like the World Economic Forum or also all the standard setting, the ISO, IFC tries to work on that. It's just trying to frame really one unified approach again, which then would, I think, as my perception, really fire also this whole as an asset class for future reference. Yeah.
So why don't we bring up the results of the poll? And I mean, I think it's a good sort of segue into talking about the SDGs, not necessarily saying that they are kind of the be-all and end-all, but obviously, as discussed sort of heavily throughout this conference and elsewhere, they're creating a framework, or at least creating a movement around impact that can be used going forward. And it's interesting to see, I think, well, you've got 40% of people saying that they plan to use the SDGs, and already 25% saying they are using the SDGs and steering their portfolio. Delilah, do you have any sort of initial reaction to that?
I do. I've tried, I think I've given a valiant effort to use the SDGs. And it's really challenging.
Yeah.
So first of all, I think, when the SDGs first came out, there were a lot of us out there who were like, great, we're gonna, oh, there goes my, well, you guys can still hear me, right? Thanks. We're gonna use these little boxes and align them with the positive impacts that we think our investments are making. And then the industry evolved and everybody was like, no, you can't just use the boxes, you need to use the underlying targets and indicators. So luckily, somebody out there did this mapping of the SDGs to GRI and IRIS. The IRIS are the Global Impact Investing Networks, the impact metrics. So it translates the SDG underlying targets, which are largely geared toward governments, as I think most of us know by now, and also which are largely geared toward developing countries. And it translates them into metrics that we might be using already anyway, that could be applicable to any investment. And I'm not sure that the mapping is exact, so I'm still working it out and figuring out if I'm comfortable using the mapping that's been done. But that seems to be one way to go forward and to use the SDGs. The other thing that's emerged, which I think is very challenging, is that people are saying you can't just use the SDGs to communicate the positive impacts from your investments. You need to think about them in terms of how you're managing your risks as well and your externalities. And I think that that's great. I think it's really important to remind investors, particularly when we're all hyped up about the clean economy and moving to a greener economy. It's really important to keep in mind the externalities and people who might be negative, people and the environment, quite frankly, that might be negatively impacting the process. Just think about like cobalt in the battery supply chain, right? Or what I was talking about with renewable projects potentially displacing people or workers, as we heard last year in Berlin at Tesla. So it's important, to keep all of that in mind. But it's also really difficult and distracting to try to track all of those negative impacts in the framework of the SDGs, which aren't even appropriate for the private sector. There are other frameworks out there that are more appropriate for the private sector, like GRI or maybe SASB. I think about materiality a little bit more broadly than SASB, but or SASB or the IRIS metrics. So. I'm interested maybe in the Q&A, and I'm interested from both of you in hearing about your experiences, but I found it to be very challenging.
Yeah, I mean, the SDGs, with the PRI, it's going to be a key part of the focus of our work on infrastructure going forward and seeing how they do genuinely apply to infrastructure investment. And I think that side of the negative impact and how you capture that is a really tricky part, but it's an essential part of it. You have to take it into account in one way or another.
I just realized maybe I should just give one concrete example,
absolutely.
Because sometimes I speak theoretically and I'm not good about giving examples. But I was reading this report that just came out recently. I think PRI was involved and I think GRI was involved, and it was about how to use the SDGs, and I forgot exactly what it was called, but it came out like a couple months ago, and I was reading it. And it gave the example of, if you're an industrial company or a manufacturer, you're constructing something, right? Best practice is to have a traffic management plan, right? You've got all this equipment that might be moving on public roads, and you don't want children or people getting hit by your equipment while you're crossing the road, so you have a traffic management plan. It's just common best practice in terms of ESG. But this report said that if you have a traffic management plan, maybe you're positively impacting SDG 3. And I was like, I don't feel comfortable claiming credit for SDG 3 because of our traffic management plan.
Yeah.
So that's what I'm talking about.
So I think, for us, we've also found, if you want to go and do the very detail and try to do everything, it does get complicated because, where do you put one versus the other? And you don't really want to have, one asset sort of counting for 16 or so 17 SDGs. But I think some of the principles around taxonomies and principles are probably sort of reasonable to sort of think about. What's sort of the biggest thing that it does? in terms of which category it might fit in. And then when you look at the detail of what it does in terms of the operations, or its presence there, does it actually work against any of the SDGs? And if you're materially working against some of the others, then you probably shouldn't count it. Mm-hmm. But if you go through that exercise, then you can say, oh, actually, great, we've got sort of infrastructure, building cities and things like that, but we haven't really thought properly around climate. So unless we actually operate it and think properly around climate, so we're not doing harm to another SDG, then maybe we shouldn't count the positive of that. So maybe some of the difficulties in sort of working through it for us has sort of helped us maybe shape a little bit more around thinking and looking a little bit more carefully at what really is going on with each asset.
Yeah.
So that's probably a positive.
Yeah.
I think it is, and as you said, like looking more carefully. I think this is really, this whole impact is nothing as a fire and forget sort of thing. It's just really, you have to be actively involved. You have to understand what you're doing there and like sensitively like try to impact something. And then, as you say, like if you on the other hand like destroy something by caring of another area, this doesn't really fly. And I think therefore also this is a bit of change in paradigm, as I called that earlier. And therefore also it makes sense that particularly if you think about infrastructure or real asset, you're able to generate an impact. And I think because it's like a smaller environment, it's like super large projects as the ones you own, but still it's a smaller environment than if you invest into a whole company or on the listed side or something like that. And therefore also the principles I think should be the same, but it's quite obvious that it's easier to create an impact and sustain an impact if you think about real assets, which is also why I think this whole impact story now is carried in via real asset finance into more of the liquid markets, at least how I see that as a pure play.
I think also, typically, if you think about the unlisted space, there's not that many owners of an asset. So a lot of the challenges that we face on listed markets is trying to influence the boards and then influence management through our collective shareholders. Well, the reality is in many cases, you just have to get 8 shareholders together or 2 or 1 to make a difference. So to me, that also means if what we expect to happen with listed companies and it's slow, but we're owning these assets and not doing and applying the same principles where actually we have more influence. So I think there is a potential blind spot in the way that we're sort of looking at our portfolios. Mm.
Yeah. So I think probably some of the issues have been touched on, but from the panel's point of view, kind of where are the main challenges to using the SDGs or other frameworks to their fullest impact or fullest extent in terms of infrastructure? What's missing? What needs to be done?
I can speak just for context. I mean, I've worked with developers directly, and private equity investors and lenders who are focused on infrastructure. So I think, translating the SDGs into real implementation on the ground, there's a lot of steps in between, and it's one of the reasons why, I say, okay, so the SDGs are great, but let's map back through GRI and IRIS, and then even then, if you're reporting through GRI or an IRIS, or you're using them as a way to manage and measure your positive and negative impacts, what feeds into that? And what really feeds into that is when you're developing an infrastructure asset and when you're operating it, you need an ESG management system with policies and procedures about how you're going to manage ESG in construction, in development, construction, and operation. I think, again, I didn't elaborate on the IFC performance standards before, but they cover the initial environmental and social impact assessment, and that you need to do that. It covers labor and health and safety, community health and safety, resource pollution and prevention, resource and pollution prevention, abatement, so, that one,
Supply
that
chain.
one, waste, land acquisition, responsible land acquisition, indigenous peoples, biodiversity, and cultural heritage. And so, you do that initial impact assessment and you put in place a system then to manage your impacts throughout the rest of the project development and operations. And you contract that plan or those plans with your contractors, with the EPC, with the O&M. You integrate the standards that you're using into a shareholders agreement, and you have assigned roles, responsibilities to execute and report back to the owners of the project, and probably the lenders as well. So
maybe, and you started on the IRIS also, like what is really needed. I think it would be really this unified, call it currency or whatever we want to call that, and this is a function of really breaking down the SDGs. But also, if you look into IRIS and like if you try to apply that, there's so many blank spots, even though by using IRIS, which no one is to blame for. But if I really could have a wish, it would be like this unified one currency you could apply across several areas of impact. Because as Kristian's examples already show, like usually you always think about impact and you can be quite consistent and apply everything, but you will come up with different KPIs. And then if it was possible to really unify that, I think that would be a big start. There's currently, for example, on the ISO 14001 and 14002, there's a lot happening trying to incorporate the standards on environmental impact. But even that is, and I'm part of the German chapter writing on the standard, it's like just unifying that language across how you want to go with that, and then thinking about social impact. Like yesterday, there was a panel here, and there was Marvin was a warehouse worker in the US, and even here you see there's social impact topics where really, as an investor, could make a difference. So, and this is coming back to what you said, like SDGs also, developing versus developed countries, how to apply that. This is the one thing which is needed, and therefore it's so important that we get started somewhere, try to have smaller bits and pieces where everyone can practice, GPs, LPs, asset owners, investors. Right now it's more of an institutional sort of topic, but I think also for retail investors will be more interesting. And then this will fire then the required capital.
Yeah, I mean, I was going to ask, where does this lead to in terms of ultimately asset allocation or reallocation, and particularly in terms of infrastructure? Is it going to drive that fundamentally?
Yep, and you're the large-scale investor, on behalf of your own book. But maybe what I can see from the clients we're facing, of course, the predominant topic is always their regulation. So if you have a fiduciary mandate, there is just currently no real room for you to embed in your decision-making something which wasn't voluntary. Yeah. So if you are, a Solvency II regulator, for example, what do you want to do? First of all, you have to generate your return. You have to think about the risks. Therefore, ESG makes sense as some sort of risk protection, but this impact you generate currently is something which is voluntary. And unless regulators see that differently and seeing the broader sense, and Kristian also touched on private financing of infrastructure versus public financing, as if that would be then baked in, that could do a lot of improvement. But Kristian's point, I guess, would be interesting on that.
I think, so for us, what was really attractive about the SDGs is that there's quite a number that just lined it up with things that we were doing that we felt added value. And the other observation is, from an investor point of view, there's a number there we're not sure whether we can, that are sort of directly investable as well. However, when you think about do no harm, I think they're really important there as well. Yeah. So for us, we've just, again, taking it a step at a time, we've just taken a subset of the SDGs that we think probably most resonate with our strategies. We've done some high-level mapping sort of exercises. We're going to contemplate. So at the moment, when we look at an infrastructure deal, we do look at very explicitly around sort of climate as a positive, negative, and so forth in the actual sort of assessment criteria, and we're thinking that we may want to sort of extend that to the SDG. So we're not going to say we're going to drive a selection from it, but let's actually start to be a bit more aware of it, and we can use that as sort of a learning tool as well. But the thing that's quite interesting is that, you know, when you look at the way a company operates, again, you know, if you just use those sort of SDGs as references, you know, are you doing harm or are you actually making a contribution inside the asset? And this is not so much to map it or anything like that, but more as a framework to sort of help the businesses that you own to not just think about the bottom line, but actually to think about, you know, what's the impact of what you do. I think that's sort of an interesting, you know, may have some interesting potential. In the same way that we're asking companies to think about it, right? These are basically operating companies.
Yeah, yeah. On that note, we've got about 10 minutes left. I'd like to open the floor up to questions.
Brandon Reese, AFL-CIO. I particularly appreciate, Delilah, your comments about applying international standards to develop markets, and that's certainly true in our experience as an asset owner, working with our infrastructure asset managers to promote the use of responsible contractor policies here in the United States to ensure that infrastructure assets are both constructed and operated with responsible contractors who not just follow the law, but also ensure fair wages and benefits for the employees, as well as mitigating project risk from by the use of highly trained employees and observing occupational safety concerns. So I really appreciate that. I do, and I'd be interested in the other panelists' experience in trying to address labor concerns in infrastructure. My other question would be your thoughts on the issue of privatization. Obviously, there are many, and it's a very country-by-country specific issue, but and there is private investment in infrastructure that's traditional, but the social responsibility issues that arise with privatization schemes of infrastructure. I'd welcome your thoughts on that.
Can I, thank you for that. Is it all right if I respond
absolutely.
directly first to the privatization question? Because it's something I think about a lot. And one of the questions, we had a lot of questions that we might have discussed on this panel. And I think one of them that we didn't discuss that I think is worth thinking about is, you know, can you make a market rate return and positive impacts at the same time, or net positive impacts? And Martin and I were discussing this yesterday. And look, I think that privatization is tough. If you're an investor with a short-term time horizon and you're looking for a private equity style return, then you're probably going to cut corners on ESG and positive impacts in order to make that market rate return. And I think that's a risk in privatization. And I appreciated the questions that we discussed earlier about, you know, what do regulators need to put in place in order to incentivize, you know, sort of, I don't know exactly what the question was, but net positive impacts. I think there needs to be more, you know, more thoughtful regulation and incentives put in place for private infrastructure developers. I think if you're a longer-term investor and you know you're looking to make a market rate return, then you probably can without cutting corners on ESG and impact. It's just the fact of the matter is that it requires a little bit more time and effort and investment up front, and patience and community and stakeholder engagement. So I would like to see more discussion around responsible privatization and mechanisms to get there. And then I think the question about responsible labor practices, was that for me or was that for you guys?
I know.
It was for you guys, I think.
So we've done in Australia quite a lot of work around building construction, and so we've got some first-hand experience around sort of the alignment of you know, labour practices and health and safety. And we've generally found that the best and most reliable companies are also the ones that support those practices.
Yeah.
So there is actually a positive correlation. And also, so when when you're building something, or when you're greenfields infrastructure or what have you. Delays cost money. Right? Defects and having to fix them up costs money. And you see lots of examples where people cut corners on safety, but then actually it slows things down because people are trying not to bump into each other, and ultimately you get injury and you get time. In terms of privatisation, that's also not easy as well for us. I mean, we have a number of governments that are privatising public assets. When you look into it, often as part of the assessment, you do sort of need to look at, well, what's the workforce now? What does it really need to be? And that, so privatisation can quite often lead to losses of jobs. One of the things that we're quite mindful of on a recent investment is if you pay too much for an asset, or you think that you're going to get value elsewhere, and then you give it to management, and then you realise you paid too much and I can't reach the KPIs, and so what's going to happen? Well, inevitably you're going to try and cut your costs somewhere, and it ends up sort of affecting the people. So we're quite mindful about also the price we pay from that, because we think that just going in and ripping out the workforce and changing is not the way that we want to do business. But sometimes you do have to restructure it, so it's something that's challenging. The other thing also is often when you are doing the due diligence, you're constrained in your capacity to engage with the unions. And so we're just trying to think about, well, how do we sort of get a better understanding before the event rather than do the due diligence and follow what we've got, and then when you land the asset, you find you've got another set of problems. So we're sort of starting to think about more proactive engagement with different stakeholders in asset classes that we might actually be sort of potentially investing in, rather than sort of trying to do it at the after the fact. And these are things that we're learning as we go. But yes, I can understand it's not easy. But we sort of, if privatisation is happening, then we hope to try and approach it in probably the best way that you can.
Yeah, and I think it's also, it's easy to look at the labour issue, I think, from a negative point of view in terms of sort of privatisation, and it's automatically going to mean job cuts or whatever, but obviously greater infrastructure investment, you look at it from the positive side in terms of job creation and things like that. So I think there's two sides to it.
Yeah, I mean, the flip side is that there are assets that we own now, and because of the growth around it, or extensions and development, it does create jobs. And again, when you're operating an asset, those labour concerns, so it's not just sort of ongoing, so at the beginning, it's as you operate it, how you negotiate with the workforce is really important.
We've got time for one more.
Yeah, Rick Walters from GRES. There's been a lot of talk about impact, which is great. Would you say infrastructure is impact investing, and if not, what's the difference?
I would say that to be honest, as big asset owners, where we allocate money impacts, right? So, and I think because of the role of infrastructure in society, it has an impact. How you manage it will sort of determine whether it's a positive, negative, or mixed impact, I believe. But would I invest in it because I feel like I want to make an impact? I'm not sure. I'd say it that way, but I think when you're investing, you should be aware that the assets that you own do impact.
Yeah, and that's also the implication. Martin,
and then maybe also shortly, I also like to distinguish between like creates an impact and it's an impact investment per se.
Exactly.
And, exactly. This is, for me, it's always a question, like, do I report ex post or do I do it ex ante? So it's this really like, do you invest into it and do you trade off between the different impacts you would generate? Coming back to this unified currency topic, where it's sometimes really hard, but this is also how I would differentiate between the two.
Okay. Yeah, one more, very, very quick.
Good morning, my name is Adam Kirkman from AMP Capital. I think with the SDGs, one of the challenges, and I think it was alluded to early on, is how is the investment more purposeful from an additionality perspective? I think, like if you think about what we see in green bond markets and things like that now, there are standards that basically say that's what now qualifies for green bond issuance. Do we need some sort of additionality framework for the SDGs? Because the SDGs at the end of the day really aren't going to be delivered if it's a sort of more of a BAU type trajectory. So how do you demonstrate that you're going that extra yard?
If I may shortly, and I think Kristian also and Delilah also are quite keen to jump on that, but just I like also starting with a debt versus equity sort of question, because it's ultimately also what it triggers. Like if we think about, I don't know, net carbon footprinting, like who's accounting for it, the debt side, equity side, both. So therefore, coming back to the clean development mechanism, where it was clearly you would aim for additionality, but as we're in a market return sort of world, this whole additionality and this proof is quite difficult, like if you really would apply CER sort of logic. So therefore, I like the question, but I think also this is something we would have to keep in mind when trying to tackle this whole question about measuring debt versus equity. But
I think it's important to think about additionality and, you know, as an investor, what are your goals and what kind of impact are you looking to make? Because every dollar or whatever the currency unit you have to spend can be used differently, obviously. But there was, just to sort of contextualize that, there was a good question at an earlier session this week that somebody asked about you know, the efficiency of capital. So, you know, how much CO2 equivalent, right, is saved per dollar invested. I think it's helpful to think about additionality in that context. Like I have X number of dollars to spend, where am I going to make the greatest impact? And I think there needs to be some thought around, you know, this whole greenwashing thing and impact washing. Are you really making an impact if you're just funneling money into, you know, same old solutions that might not be making the most efficient or innovative use of your dollars? So I just think that's something to think about.
All right, well, probably we've run a minute over time. We've been warned of severe punishment if we go any further. So thank you very much to the panelists. I think we've had a really good discussion, so thank you.